All right, let's do this. Mr. Mesh here. I hope you are doing well. Welcome to the second part on private real estate. And in this section, we are going to look at property value. So we'll consider real estate economic value drivers, and then we'll conclude by looking at real estate portfolio characteristics. Let's get right into this. The theory is pretty straightforward. Our main focus is going to be on the practical application, the change in value based on any of the economic value drivers. And we'll look at how these changes are going to change the different matrices that we've been calculating. So it's very good practice because we'll be redoing all those other calculations we have done before so that we get to understand them better. And then we are going to go further to calculate the property values using the cap rate and so forth. Let's get right into this. Private real estate economic value drivers include income and price appreciation, and this is determined by the current and future economic use, both for residential and commercial properties. Economic value drivers are property features like the location, age, amenities, and these are pretty straightforward. And the macroeconomic variables are like your gross domestic product, job growth, the wage growth. All of these would be positively related with rental rates and real estate prices. So if the economy is growing, people are getting more jobs and they're getting paid more, likely there's going to be a higher demand for property. In local conditions like the business climate, infrastructure, favorable regulatory or tax policies, proximity to suppliers, customers, and so forth, all of these things have an impact on the value of property. So, like I said, the theory is really straightforward. It's something that by now you should know. In terms of commercial real estate, this is a key input in many industries, and the demand is going to be driven by rising employment, population growth, and consumer confidence. These are the things that are going to boost businesses. And opportunistic investments, remember we said these are usually properties that are in distress. So these are distressed properties, and the focus mainly is on the price appreciation of the property. You take a property that is run down, you renovate it, you refurbish it, you grow the value, and then you resell it. That's what opportunistic investments are. The timing of real estate cycles and rising rental occupancy rate signal market supply increases. And investment decisions consider market conditions from the project inception up until the project is completed. So this is a project development in the real estate life cycle. This we've talked about this a bit earlier, where we said the net income resembles the J curve, which is typical in private markets. The net income firstly is negative when income is committed, then deployed until the project starts and the income starts to come in. Then you now have your capital distribution. So there's the planning and acquisition, construction phase, completion, and lease, where once this is completed, you pay back the short-term C&D loan, construction and development, and then take a longer-term mortgage, then the operation of the property. And this is shown on this cycle here. The new construction, which is typical to the recovery on the business cycle. And at the peak of the business cycle, you can also have new constructions, high occupancy, project is completed, and you can have an oversupply of property during a recessions on the business cycle when the economy is going through a downturn. Okay, so like I said, this is going to be practical. The theory is something that we cannot overemphasize because I believe you guys have a good understanding of this. Let's do this. As usual, I expect you to read through this and then we do it together. What we want to do, we are still continuing with the Panda East project, and we want to calculate the revised before cash flow and equity dividend rate for the Panda East project under the new market conditions. So the market conditions have changed. There's been an oversupply phase in the real estate cycle. And due to the regional multifamily housing glut, the owners must reduce the rental rate. So the average rental rates have been reduced. Let's calculate, because to get the before tax cash flow, this basically is given by the net operating income minus the debt service. Okay. And then we use this to calculate the equity dividend rate, where the equity dividend rate is this before tax cash flow divided by the value of equity. This net operating income, by now you must be able to do it with ease. We calculate the effective gross income minus the operating expense minus the property maintenance. The effective gross income is multiplied. To get this, we get the gross income, and then we multiply that by the occupancy, which is reduced to 85%. So we are going to multiply the 1,200 feet multiplied by 1,200 units multiplied by the revised rental rate, which is 2.5, and then we multiply this by the occupancy to get the effective gross income. We subtract the operating expense, and we are told that operating expense is 30% of gross. So this is 30% of the gross, which is still 1,200 times 1,200 times 2.5, and both of these are supposed to be multiplied by 12 for the entire year, and hence the net operating income would then be, we can simply take this, if you solve this, you should get the net operating income equal to 23,760,000 is the net operating income. Okay. Now we have this. We now need to get this debt service. To get the debt service, we get it annually, because remember, the net operating income we multiplied by 12. This is the annual net operating income. So we need the annual debt service. We are going to use these values here. We have the tenure of our loan of 20 years. So we have N20, we annualize it. The interest rate, we are supposed to give it a month per month, it's 7. So we are going to say 7 over 12. And then we are going to take the price of the loan, this one, present value of the loan. The present value of the loan, 206,250. This is 200 million. Okay, and then we are going to compute. We need to compute the PMT, which is the monthly payments, because remember, we are getting monthly here. We have to multiply it by 12 to make it annual. So we calculate the PMT, we compute this, and then the answer we get here, we multiply by 12, such that we get the debt service as being equal to 19,188,649. Okay, which therefore means that the before tax cash flow is going to be the net operating income minus the debt service. And when you solve this, it must be 4,571,351. And the equity dividend rate now, this one, the equity dividend rate would then be equal to the before tax cash flow, 4,571,351. Then we divide by the equity. This equity is simply the value of the property minus the property value minus the debt. outstanding debt. Remember, we use the face value of the debt here. We are going to use the par for the debt, and here we use the total cost of property. We use the cost at inception. Okay, so this is equals to 4,571,351. We divide this by the cost at inception is 275 million. And then the par value of the debt is 206,250,000. Okay, and then if you solve this, put these numbers into your calculator, you are going to get the equity dividend rate of 6.65%. So there's nothing new here. These are things that by now you must be familiar with. You must know each and every one of the formulas that we have used to solve this. And obviously this is highly testable. Let's go on to the next one, where we are going to calculate a few new things now that you haven't seen up to this stage. Okay, recall the Panda East project, which is the one we are still working on. Initially, when we calculated the expected project rate of return, we got 11.23%. What we want to do now is to determine the property value using this return, this 11.23, as the capitalization rate, the cap rate. Additionally, we are going to consider a 15% hurdle rate as a reasonable return on equity. So remember, we are going to consider this as a reasonable return on equity for similar projects. We use this now to calculate the debt service coverage ratio and the loan to value ratio. We want to calculate these two ratios here. Okay, let's do this. To get the value of the property using the cap rate, the property value is equal to the expected net operating income divided by the capitalization rate, the cap rate. And we make an important assumption here. We are going to assume that the net operating income that we calculated is going to continue into the future. So that's an important assumption, which means that this value of the NOE is the stabilized NOE. This continues into the future. You know how we make this assumption that the final value has to perpetuate going forward. And hence the property value, the expected NOE is the value that we just got for the NOE, the 23,760,000. We divide this by the cap rate. This is given based on the expected project return, which is 11%. If we calculate this, we are going to get the property value being equal to 211,576,136. So this is going to be the property value. All right. And then we are also told that this 15% hurdle rate is a reasonable return on the equity assumption for similar projects. We're going to use this 15% as a reasonable return. So we consider this to be the equity dividend rate, since it's a reasonable return for similar projects. The equity dividend rate formula, remember we said this is given by before tax cash flows divided by the value of equity, which means the market value for our equity in this instance would then be the before tax cash flows divided by this return of 15%, which is equals to the before tax cash flows. We calculated this as 4,571,351. This is just in the previous question we did. And then we divide this by 15%. If we divide this by 15%, we are going to get the market value of equity being equal to 30,475,673. We get this amount here. Now, the question is asking us to calculate the debt service coverage and the loan to value ratio. The debt service coverage ratio is calculated using the net operating income and the debt service. Okay, so this is pretty straightforward. This part is pretty straightforward. The net operating income, we calculated this already. This is the net operating income. We got this as this one. We have this value 23,760,123. And then we divide this by the debt service. We calculated this using the PMT times 12. And that value, when we calculated it using our financial calculator, was 19,188,649. Hence, the debt service coverage ratio is going to be equal to 1.24 times. Okay, the debt service coverage is going to be this. And you see, if you compare to the initial value that we calculated in the first one, the initial one was 1.61. This is what we did earlier. After the economic conditions seem to have worsened, we have this 1.25. We can compare these two values here. Let's go on to the loan to value ratio. The loan to value ratio is calculated as the loan over the value. The loan is the debt. So what we want to do is to get the debt outstanding and then divide by the total value. All right. We want to look at the total value of the asset that is also outstanding. We then get the loan to value ratio equals to the debt outstanding is going to be given by the par value of the debt, 206,250,000, divided by the current property value. The current property value we calculated. This one is the current property value calculated using the cap rate, 211,211,576,136. We calculate this, put in your calculator, we are going to get 0.97. This basically means that we have an increase in leverage, because initially when we calculated we had a value of 0.75, but it has basically gone up, so we have an increase in the leverage, and the market value for asset has actually gone down because of these changes in economic conditions. Okay, let's see the next one. Again, you can read through this, try this on your own first, and then we can do it together. So you can pause, come back, and then we do this together. I hope you give it a try. But if you read through this, we want to assume a cap rate of 12. You'd want to use the direct capitalization method to estimate the property value based on prior year net operating income. The property value would then be equal to the expected net operating income divided by the cap rate. This is very easy. The net operating income is given here, 3,200,000. This is divided by the cap rate, which is 12%, 0.12. When we divide these two, we are going to get the final answer of 26,666,667 Canadian dollars. So, like I said, this is pretty straightforward. And then the second question, the GP learns that the current year occupancy has fallen to 80% as the tenants shift to hybrid work policies, fail to renew the multi-year leases. They've shifted, they are not paying their multi-year leases. Calculate the expected current year net operating income and property value is in question 1 for the current year using the same capitalization rate, revenue, and expense assumptions. Okay, so if the occupancy has declined to 80%, what this basically means is that there's going to be a change in the occupancy. We are going to have fewer tenants. Okay, and the gross rent was 10 million here. The effective gross rent is going to decrease. We get this decrease by decreasing this by 20%. So we're going to take the 20% of this 10 million and we get 2 million. Okay. The other revenue and expenses, they are unchanged since the gross rent does not change. So the gross rent is not changing. What is just changing is the occupancy, which therefore means that the net operating income is simply going to be the 3,200,000, that's value here. Then we subtract 1 million. And then we get the net operating income of 2,200,000. All right. So we subtract with the 1 million here because this 2 million is the total reduction based on 20%, but initially it was 90%. Hence, the only half of this is what is going to decline in the net operating income. It's half of the 2 million. All right. Because initially the occupancy was 90%. So for 90%, we have 1 million. When you go down to 80%, it's another 1 million. Hence, we just subtract 1 million here. After we get this, the property value becomes simple. The property value is then going to be equal to the expected net operating income over the cap rate, which is equal to 2,200,000 divided by the cap rate. We are told that this remains the same, and we're going to have 18,333,333, and we see that there's a decline in the property value because of this change in the occupancy. And then we want to evaluate the appropriateness of using direct capitalization method from a seller versus a buyer's perspective. Just think about it and then listen to what I have to say. Remember the direct capitalization method, we have talked about this to say the property value is just the expected net operating income over the cap rate. So this expectation on net operating income is based on the continuation of the property being used for the same economic use. So from the seller's perspective, they are projecting this net operating income based on what they believe is going to be the occupancy. And this expected normalized, the expected net operating income is what they expect to continue happening going into the future. This assumption is going to be reasonable from a seller's perspective if they believe that there's not any changes in demand are structural changes, which means these are permanent changes and are likely to persist for a very long time. And this estimation of the expected net operating income is then going to be valid. All right. And from a buyer's perspective, the buyer can consider how they want to use this particular property. If the buyer is going to continue with the same economic use and they also believe that the demand change is structural, then they will take that estimation of the property value. But if they want to use the property for something else, they might have to consider other evaluation matrices. So whatever valuation matrix that's going to be used is going to be dependent on the economic use by the buyer, because the seller is valuing based on what they are using it for, and they use particular assumptions. All right. So let's give this a try as the final exercise. I hope you guys are understanding this. Not too complicated, but you just need to understand what is going on. So read through this and then we'll do it together. We have a capitalization rate of 17% here. And the expected net operating income is given here. So for end of year 3, we have end of year 3, we take the net operating income in year 4. Property value is going to be the expected net operating income, which is for year 4, and then we divide this by the cap rate. Quite straightforward. Okay, and this is the net operating income for year 4. Then we calculate this. So this is then going to be 6,412,500. We divide this by the cap rate. The cap rate 17%, 0.17. And hence the property value is going to be 37,720,588 Canadian dollars. That's as easy as ABC. I hope you managed. I really hope so. Let's go to the next one. Give it a try. You are given that the expected projected cash flows. You are given the expected project cash flows. What should the GP be willing to pay for the property today to achieve a hurdle rate of 17%? So we are going to look at these expected project cash flows. These are given here. I'm going to go back. You take a look at them and then we continue. Year 0, you purchase the property. Year 1, operate office building at 80% occupancy while obtaining permits and assuming the year 1 net operating income is 2.2 million from the previous case study. Year 2, you renovate vacant floors while operating remainder of office building under existing leases. Renovation costs exceed second year net operating income for a net cash flow of negative 2 million. And then in year 3, you're also going to have a renovations cost to exceed third year net operating income for a net cash flow of minus 2 million. And then in the final year, you have this expected fourth year net operating income to be 6,412,500. So these are the cash flows that we have. We are going to put this into a timeline. Just take note that in year 0 is the purchase of property, and then year 1, 2.2 million, which is positive, negative in the second year, and also negative in the third year. And this is what we use to determine the terminal value. Okay. Let me draw a timeline here. And we have time 0 here. This is the time. We have time 1 here. We have time 2 here. And then we have time 3 here. Given the expected project cash flows, right? What should the GP be willing to pay? This is what they are paying. It's the value at this point in time here. And this is what we want to calculate. And we are told, remember the cash flows I was reading just now, that the net operating income for year 1, this was 2,200,000. Then the net operating income for year 2, this was a negative 2 million. It was negative 2 million for year 2. The final one is where it's a bit tricky now, because for the net operating income for year 3, we are going to take the negative 2 million. We take the negative 2 million. This is separate from this. This is for year 3, negative 2 million. But we are going to also have to determine the terminal value. So we add the terminal value. The terminal value, it takes into account the expected future cash flow. So the terminal value is going to take the net operating income in year 4, and then we divide this by the cap rate, which means we have your minus 2 million. The operating income in year 4 is given as 6,412,500. Then we divide by the cap rate of 0.17, which therefore means that in year 3, the total income is the summation of this negative 2 million and this, which should be 35,720,588. So what you're going to do is to put in your cash flows. Cash flow 0 is what you are trying to calculate. Cash flow 1 is going to be 2.2 million. Cash flow 2 is going to be negative 2 million. And cash flow 3, the final one, is this here, 35,720,588. And we want to achieve a hurdle rate of 17%. So we are going to we want to meet this. We have to compute the internal rate of return, and our answer that we compute must be close to 17%. The only way we can do this is to do trial and error. So you can pick a number close to this terminal value and try maybe 30 million. What you see is that when you try 30 million, you are going to get an internal rate of return of 6.35%. This is too low. We want 17%. So you have to increase. For you to get a higher return, you have to reduce the amount you are willing to pay for the property, right? So you can reduce this to 20 million. So you then try 20 million. It's trial and error, 20 million. If you use 20 million, you're going to get an internal rate of return of 22.276, which we see that this is now too high compared to 17%. You can then try 22 million. Basically, what you see from this is that the GP should be willing to pay between 20 and 25 million. That's where your answer is going to be using trial and error. It's difficult to get the exact answer using the financial calculator. Alternatively, you can use the go-seek function in Excel. I have a video that I showed how to use the go-seek function in Excel. I can do another one to show you how you calculate internal rate of return using the go-seek function. It makes things easier. You will be able to get this final value, but your answer should be between 20 and 25 based on what I've just explained here. All right, so in the next session we are going to do some practice, but as we wrap up this, we just talk about the private real estate portfolio characteristics. This is the final slide. The investment strategies, they focus on renovating. This is on the value add. So there are different strategies that you can use. You can use the value add where you renovate, reposition the income generating property, or opportunistic, which I said these are distressed real estate properties. So this involves new development or repurposed properties. They have longer time periods and the initial cash flows are going to be negative because you have distress here. So, and then the third one is the risk return. The higher the risk, you have the higher expected return, especially with these income producing properties. If it's risky and you manage to get it right, you are likely to get a higher return. Remember, we said if you look at these investments, the risk and return is like this. If you have high risk, chances are you're going to have high return. There's this direct relationship where the highest risk are the opportunistic, where you in the value add are moderate risk and moderate return. Okay, these are the value add. Okay, so the higher the risk, the higher the return. The moderate the risk, the moderate return. The low risk one, these are like public securities where it's safe but the returns are also low. But once you go up here, these are the more in the private market. The investments often involve multi-year cash calls or commitments, and returns are realized upon project completion and sale. Illiquidity and net asset value uncertainty. The longer the time horizons, the more illiquid it is, and during construction, there's no money. The money is held in the construction, the paying of the construction workers, the buying of the land, the buying of whatever is used in the construction or the renovation phases. The net asset value is uncertain until the projects are completed. The secondary market liquidity. Limited partners secondary market. This allows limited partner investors to sell interest before the fund's termination. So if they go into secondaries, the limited partners can sell their interest before the fund is terminated if they are in need of money for whatever reasons. And the GPs may lead secondary transactions to offer interval funds. Remember, secondary funds are highly liquid. There's an exposure to more investors, and hence there might be a need for more funds, and this could increase the funds for the investment. Liquidity might disappear during market stress. If the markets are not performing well, either there's a recession or whatever is going on in the market, then the liquidity is going to likely to disappear. Like I said, we are going to do another session where we practice to drill in this concept. So you see that now I do a lot of practice exercises such that the more we practice, the more we grasp these concepts. But for now, Mr. Mesh is done. Enjoy real estate. Keep smiling, keep working. Cheers.